I just give you some bullet points here because this was a big week, and you're seeing it in the stock market today. The market's up 258 points and up for the week. But I think the reason for this is that if you add up everything that occurred this week, you're actually seeing a change in sentiment a little bit. It's like suddenly the stoplight turned from yellow to green. And what I mean by this is the Fed has now uninverted the yield curve. That's huge. And then the consumer data, spending data that was released this week is really pretty outstanding. I'm not seeing many people talk about that in those terms, but I think it is. You'll see why I say that. And I think it'll continue to drive GDP growth despite the trade war and weak manufacturing. That's what we've been saying all along. That has been the consensus view. But I think it's pretty clear that there is no recession in sight. And the Federal Reserve confirmed that with their statement. The inflation data was terrific. It was a positive surprise. We're seeing great jobs and income, and importantly, savings data. The jobs and income were reported this morning. Big upward revisions to last month and the month before, and also, despite the problem that Boeing is having and the General Motors strike. So even notwithstanding those two drags on job formation, we saw an upside surprise in the jobs numbers. And then the last two bullet points here really relate also to the health of consumers. And again, that to me is a sort of a very important module to talk about all of the things, all of the data points that relate to consumers' ability to continue spending money, because that's the crux of the economic outlook. People are saying, yeah, we have weak manufacturing, we have weak exports, and the bulls have been saying, well, it's not going to matter because consumer spending will carry the day, and that's exactly what's happening. And if anything, I think consumer spending probably picks up. I'll tell you why that is the case in a second.
The Federal Reserve has just uninverted the yield curve, and the economic horizon turned brighter. Despite the trade war with China, slump in manufacturing, and political uncertainty, clouds threatening an end to the 10.5-year-old expansion have cleared. The uninversion is the most important financial news of 2019. The Fed loans money to banks at about the rate of a 3-month T-bill, and banks loan it out at long-term rates. The difference between those two interest rates is the yield curve. When a 10-year Treasury bond rate is lower than the interest rate on a 3-month T-bill, the yield curve is negative or inverted. It turns the financial system upside down, and long-term lending and investments slow nationwide. The yield on a 10-year Treasury bond fell below the yield on a 3-month Treasury bill on May 13th, and the inversion worsened through September 3rd. The Fed had responded quickly and had changed its policy to stimulate business activity back in January and has lowered short-term lending rates 3 times in 2019. And after maxing out on September 3rd, the yield curve began uninverting, and it's again right side up. The restoration of financial logic indicates that investors worldwide believe the Fed reversed itself quick enough to avert causing a recession. The threat of a recession is over, and the economy is back on track to continue to expand.